Is Realty Income still a safe dividend stock, or is the yield hiding risk? Realty Income is famous for one thing: monthly dividends. But a dependable dividend stock can still be a disappointing investment if the price, debt cost, and growth rate do not line up. Today we are looking at Realty Income, ticker O, and the real question is the monthly dividend company still worth researching here, or is the market not giving us enough margin of safety? By the end of this video, you'll know whether the dividend looks covered, what fair value range I'm watching, and what could turn a safe-looking REIT into a yield trap. For me, 3 numbers decide the setup: AFFO per share, dividend coverage, and debt cost. The short version is this: steady dividend, but price still matters. Keep that line in mind, because a reliable monthly dividend does not automatically make the stock cheap. So, what are we trying to find out? This is not financial advice. I'm going to walk through what Realty Income does, what happened in the last quarter, how the price chart looks, how the FinanceToGo scorecard comes out, what fair value could be, and then the bull case, bear case, risks, and my final verdict. The reason Realty Income matters right now is that the company just reported Q1 results, raised cash earnings guidance, and the stock is trading near the middle of its recent range instead of at a screaming bargain price. If you like income stocks but do not want to chase yield blindly, this is the framework I would use. If you want stock breakdowns that test the dividend, the valuation, and the risks without the hype, subscribe to FinanceToGo. The goal on this channel is to separate dependable dividend opportunities from yield traps using numbers, valuation, and plain English stock analysis. So, what kind of business is Realty Income? Realty Income is a net lease REIT. In simple terms, it owns properties, rents them to tenants under long leases, and uses that rental income to support monthly dividends. This is not supposed to be a fast growth stock. It is more of a steady income business where the key question is whether rent, acquisitions, and financing costs can support slow but dependable per share growth. Here's the simple version. Realty Income has scale, a huge property base, high occupancy, and one of the most recognizable dividend records in the REIT world. That is why income investors pay attention to it. But the business also needs capital to grow. If debt gets expensive, or if the company issues shares at unattractive prices, growth can look good at the property level without helping shareholders much. So I like the simplicity of the rent and dividend model, but I do not want to ignore the funding question. For this stock, the dividend is the headline. The cost of capital is the test. So, what is the market already telling us? The main thing I want you to notice on this chart is that Realty Income is not trading like a distressed REIT, but it also is not priced like a high growth compounder. The stock is around $62, which puts it in a fair price debate rather than an obvious bargain zone. That matters because income investors can get too focused on the dividend and forget the entry price. If you overpay for a slow grower, the dividend may be steady, but the total return can still disappoint. So, did Realty Income have a strong quarter? The latest quarter was solid. In Q1 2026, revenue was $1.55 billion, up 12.2% year over year from $1.38 billion last year. Net income was $311.8 million, or 33 cents per share. For a REIT though, the more useful number is AFFO, because it gives a cleaner view of recurring property cash earnings. Realty Income reported $1.06 billion in adjusted funds from operations, and AFFO per share was $1.13 per share, up 6.6% year over year. Occupancy was 98.9%. Rent recapture was 103.4%, and management raised 2026 AFFO guidance to $4.41 to $4.44 per share. That is the good news. The part I would not overhype is growth. Same-store rent growth was modest, and realty income still depends on acquisitions, debt, and equity funding to keep expanding. So the quarter supports the dividend story, but it does not remove the price and interest questions. What improved and what still needs watching? What improved was cash earnings, guidance, occupancy, rent recapture, and the investment pipeline. More specifically, AFFO per share grew 6.6% per year over year to $1.13. Full year FFO guidance was raised to $4.41 to $4.54. Rent recapture was 103.4%, as we previously mentioned, but what still needs watching is the slow organic growth, leverage funding costs, and dilution risk. More specifically, same-store rental revenue growth was only 0.8%, so organic growth is still modest. Leverage remains important at 5.2x the net debt to adjusted EBITDA. The business depends on access to capital, so higher borrowing costs can reduce the value of new deals. ATM forward shares and external funding can create dilution if growth does not earn attractive spreads. The bulls are right that Realty Income is one of the most proven dividend REITs, but they may be ignoring how much the stock still depends on interest rates and access to capital. The bears are right that growth is slow, but they may be missing how valuable steady AFFO and monthly dividends can be when the price is reasonable. So I do not want to summarize this as either perfect or dangerous. It was a steady quarter. The dividend looks supported, but for the stock to work well from here, the company still has to prove that new growth is creating value after financing costs. So where does Realty Income score well and where is the test harder? The scorecard is useful because dividend stocks can feel safe just because they pay regularly. But the real test is whether the dividend is backed by cash, whether the balance sheet is manageable, and whether the valuation gives investors enough room. Here's the return Realty Income. Growth score is 5 out of 10 because growth is steady, not fast. Guidance improved, but same-store rent growth is modest. Profitability score is 7 out of 10 because the rent model is profitable, but REIT earnings need a cash earnings check rather than EPS alone. Cash flow score is 8 out of 10 because cash earnings cover the dividend and remain the strongest support for the income thesis. Balance sheet score is 6 out of 10 because liquidity is strong, but leverage and refinancing costs still matter. Valuation score is 6 out of 10. Because around $62, the stock looks fair to reasonable. Not obviously cheap. Shareholder friendliness score is 8 out of 10 because monthly dividends, long dividend history, and the covered payout support income investors. Risk score is 6 out of 10 because interest rates, tenant risk, leverage, and dilution keep the setup from being risk-free. Momentum score is 7 out of 10 because Q1 was steady, cash earnings grew, and management raised guidance. So when I summarize the scorecard, the strongest parts are AFFO, dividend support, and business stability. The weaker parts are growth speed, rate sensitivity, and the fact that the current price is not obviously cheap. So what is Realty Income worth if cash earnings hold? For a valuation, I do not want to use standard EPS as the main anchor because REIT accounting can make EPS less useful. the better starting point is recurring cash earnings per share. Then I want to cross-check that with dividend yield and with the balance sheet. So for this analysis, the fair value range is $60 to $68. And the buy zone discussion starts below roughly $56 to $58, at least for me. Or at least when the dividend yield offers a wider margin of safety. The valuation methods behind that are cash earnings valuation, the most important method for a REIT because EPS understates real estate cash earnings. Dividend yield valuation is useful because Realty Income is owned largely for monthly income and dividend growth. Balance sheet and cost of capital check required because a REIT can look safe until debt costs and share issuance pressure returns. The key point is simple. Realty Income does not have to be a bargain basement stock to be worth researching. But the growth rate is modest. I want a fair price or a better yield before calling it attractive. Steady dividends, but price still matters. What has to go right for O stock to work? The bull case is that Realty Income is one of the most proven income REITs in the market. It has scale, diversification, high occupancy, monthly dividends, and management just raised guidance. The company does not need explosive growth. It needs steady cash earnings growth, a cover dividend, and disciplined investments. Realty Income owns a huge diversified net lease portfolio with 15,571 properties and 1,786 clients. Occupancy remains very high at 98.9%, supporting dependable rent collection. Cash earnings per share grew and guidance moved higher, which supports dividend growth. Private capital partnerships with Apollo and GIC may help Realty Income grow without relying on public equity markets. If that happens, Realty Income can remain a useful dividend compounder, especially for investors who care about regular income and lower drama. So, what could turn a safe dividend into a yield trap? The bear case is not that Realty Income is a bad business. The bear case is that a good income business can still be a poor stock if investors pay too much or funding costs squeeze growth. The main risks I'm watching here are interest rate risk, debt and refinancing risk, tenant and retail exposure risk, dilution risk, slow growth risk. The bear case points are: this is not a high growth stock, same store rent growth was only 0.8%, REITs need capital to grow, so higher rates or weak stock price can make acquisitions less attractive. Leverage and refinancing risk matter because the company carries meaningful debt. If new shares are issued too cheaply, per share growth can disappoint even when the property portfolio grows. For me, the biggest risk is that acquisitions look impressive in total dollars, but do not translate into enough per share growth. If the company has to issue stock or borrow money at unattractive costs, the property portfolio can grow while shareholder returns stay average. So, what would change the thesis next quarter? What to watch next quarter is where this becomes practical. I would focus less on the dividend headline and more on whether the numbers behind the dividend are moving in the right direction. The main items are cash earnings per share versus the guidance range. Occupancy staying near 98.5% or better. Same store rent growth improving from 0.8% net debt to EBITDA, moving lower or staying controlled. Investment spreads versus borrowing costs. Dividend payout ratio versus cash earnings. My next quarter scoreboard is cash earnings per share, dividend payout ratio, occupancy, same store rent growth. The thesis breaker list is simple. Cash earnings guidance gets cut, occupancy drops below the guidance range, debt costs rise faster than investment yields, the payout ratio moves too close to the danger zone, share issuance fails to translate into per share growth. The two phrases I would highlight are cash earnings per share and debt cost. If that cash number keeps moving higher while leverage stays controlled, the income case gets stronger. If debt cost rises faster than investment returns, then the stock may deserve a lower valuation. So, is Realty Income a buy zone candidate or a dividend watchlist stock? My FinanceToGo verdict is worth researching, dividend watchlist, not a slam dunk bargain. Realty Income goes in the dividend watchlist bucket. The positives are clear: monthly dividends, high occupancy, cash earnings growth, and raised guidance. The concerns are also clear: slow organic growth, interest rate sensitivity, leverage, and valuation. The title I promised was Safe Dividend or Yield Trap, and my answer is steady dividends, but price still matters. The reusable lesson is that a reliable dividend stock can still be a mediocre investment if the price, debt cost, and growth do not line up. I see Realty Income as a quality dividend name worth researching, but not something I would call automatically cheap around the low 60s. I would get more interested with a bigger yield, a lower price, or clearer evidence that cash earnings growth and funding costs are moving in the right direction. If you want to follow dividend stocks as the numbers change quarter by quarter, subscribe to FinanceToGo. That is the point of this channel, checking whether the story, the dividend, and the valuation still line up. Also tell me in the comments, would you rather own Realty Income for monthly income or wait for a lower price and a higher yield? And again, this is educational content only, not financial advice. Always do your own research and make sure any stock fits your own strategy, risk tolerance, and time horizon.